Hello, everyone. It is me again. I am putting together another Zoom lecture video, if you will, to help everyone out with journal entries. Looking at this past assignment for week 2, it was heavy on journal entries. Some of you have a great grasp on journal entries, and then others need some work with them. The journal entries are extremely important because, especially if all of you were looking at your comments on your assignment, if the journal entries are wrong, everything else is wrong. So even if your formatting was right on the postings in the general ledger, even if your trial balance, you put in the correct formatting there, they were wrong if your journal entries were wrong. I gave points based on if you did it right, based on your answers anyways. To an extent, but we have to start fresh with journal entries to really understand how to do them going forward. So what I'm going to do here today, I set up only 5 journal entries, and I'm going to go through how each of you should be going about doing the journal entries until you are comfortable with them. All right? To do this, I have an Excel file, and I'm going to use the cheat sheet that I posted. Okay? If you need access to the cheat sheet again, I will post it with this announcement. All right, so let's go to the file. So we're dealing with Bruce Wayne had the following transactions for the month of January. Number 1, he invested $100,000 cash to form a new business. So he's forming a business. He's putting cash into the business. Here is how you should start your journal entries. Before you even do anything, ask yourself, what accounts are being affected by this transaction? So from the business's point of view, if the owner is putting cash into the business, cash is being affected. And since we're dealing with an owner, owner's capital is being affected. All right. If you struggle thinking of accounts, read the transaction, go to the cheat sheet, and see if any of these stand out as something that the transaction talked about. Cash was there. And then since it's an owner, you have owner's capital or drawings. Drawings are only when the owner takes money out, so it has to be capital. All right? So we know it's cash and capital. Next, what I would do is I'd scroll down here to this table where debits and credits do. Let's look at cash. The owner is putting cash into the business. So from the business's point of view, is cash increasing or is it decreasing? It's increasing. The business is receiving cash. So since cash is an asset, again, you could use this to help you till you get familiar. Cash is an asset. If it's increasing, then you debit cash. So go to your journal entry, and I'll write the words debit cash 100,000. Next, owner's capital. Go back here to your cheat sheet. Owner's capital is an equity account. The chart I put down here breaks it by itself. Whenever an owner is putting money into their business, their capital is increasing. So since it's increasing, owner's capital must be credited. And remember the rules of a journal entry. Each journal entry has to have at least one debit and at least one credit. And also, the credits and debits must equal. All right, so remember, debits are shifted to the left, credits shifted to the right. You don't have to write debit and credit here. As long as the cash is shifted and an owner's capital is shifted, I know what's debited and credited, okay? So here's what I do before even going on to the next transaction. Post what you did. So cash was affected. Go over here to the cash general ledger account. The reference number should be the journal entry number. So number 1, cash was debited $100,000. That would make its balance $100,000 because nothing else has happened yet. Owner's capital, go to owner's capital, same reference number because it's from the same journal entry. It was credited $100,000. Thus, its balance is $100,000. Okay? Now we're going to go on to journal entry number 2. The business purchased equipment for $2,000 cash. Start the same way until you're comfortable. Go to the cheat sheet. The business purchased equipment with cash. What accounts would have been affected by that? Well, they're purchasing equipment right here for cash. So equipment, you could say office equipment or just equipment, and cash are affected. So since they're purchasing equipment, is the total value of that business's equipment increasing or decreasing? It's increasing because they're purchasing it. So since equipment is an asset, we're going to go down here. And again, until you're comfortable, look at the chart. When assets increase, you debit them. So on our Excel file, we're going to debit equipment, $2,000. Now the problem says they purchased it for cash. So when a business buys anything with cash, the balance of their cash is going down. So cash is an asset. When an asset decreases, credit it. So we're going to go ahead. We're going to say credit cash 2,000. All right. Before going to the next entry, let's update the ledger. Cash reference number, second journal entry. So reference number 2, we credited it for 2,000. If it had a debit balance of 10,000, we just reduced it by 2,000. Its new balance is 98,000. All right, I'll put those in dollars. Yeah. All right. Equipment, where do I put it? Down here. So we just reference equipment number 2. We debited it, that same $2,000. So its balance is $2,000. Put it in cash again for you. Okay. Now we could go ahead and move on to number 3. The business sold merchandise for $10,000 on account. All right. 2 of these to talk about. The business sold merchandise for $10,000 on account. Whenever they sell merchandise, that's revenue. When a business sells something or provides a service, it is revenue. All right. When it's a service, it's called service revenue or fees earned. When it's a sale of merchandise, of goods, so physical goods, it's called sales revenue. All right. So they sold merchandise for $10,000 on account. The key there is it says on account. That means they didn't sell it for cash right then and there. They sold it on account. So looking at your cheat sheet, here's what I would do again. They had a sale. The revenue account here doesn't say sales revenue, so just add it on your own. Sales revenue, when they provided goods, and now they didn't receive cash. Whenever a problem says on account, so if a business sells something on account, it means they're going to receive cash in the future. The placeholder for cash that is going to be received in the future is accounts receivable. Okay? So the balance of their accounts receivable is increasing. Again, it's an asset. When they increase, you debit them. So we're going to go here, debit, accounts receivable for $10,000. Revenue, when revenue was earned, it's increasing. So their total revenue that they've earned has increased by $10,000. To increase a revenue, you have to credit it. So go here. We're going to credit. I'll say sales revenue, $10,000. All right. Just before we post, accounts receivable is when your business is going to receive cash in the future. So when you sell something or you provide a service, but you didn't receive cash yet, it's accounts receivable. Accounts payable is when your business owes money in the future. So they bought something, but they didn't pay for it today. Accounts payable means they have to pay for that later. So just make sure you know the distinction. All right, we're going to go ahead and post these to the ledger. So accounts receivable, find it here. It's from journal entry number 3. We debited it for 10 grand, so its balance is 10 grand. Sales revenue, reference 3, we credited it for 10 grand, its balance is 10 grand. Money. All right, so we're going to move on. Number 4, the business paid rent for the month for $800. So here's something. If a transaction does not stipulate, does not say the words on account, you always assume cash was used or cash was exchanged. So in this, the business paid rent for the month for $800. Since it doesn't say on account, it means they paid for that expense with cash. So if you're going to pay an expense, the total value of your expenses increases. You can look here at the chart. There's an expense for basically every specific thing. Rent expense. So when you incur an expense, when you pay an expense, it's considered that this account is increasing. So when expenses increase, you debit them. So we're going to debit rent expense. And we want to say expense. We want to be specific. $800. Next, we're paying it with cash, okay? Even if it doesn't say cash, as long as it does not say account, you assume cash. So think about when you pay your bills. If you pay a bill out of your bank account, your balance of cash is going down. So cash, an asset, is decreasing. We have to credit it. Credit, cash, 800. We're going to go ahead and post. So this is journal entry 4. Cash was credited, 800. Its new balance is now going to be 97,200. Real quick, before I post in rent expense, how do we know if a debit increases or credit decreases these accounts? It's the same that's on this chart. So for any asset, whenever it's debited, their total value increases. So this $100,000 was positive. Whenever an asset is credited, its value decreases. That's why all of these are bringing down the value of cash. So when you look at the cheat sheet, the opposite is true for liabilities. So if we had a liability, debits would decrease the total balance, while credits would increase, so on. All right, rent expense. We debited it for 800. Journal entry 4 is the reference, $800. Balance would be $800. Okay, making money. Last one. Bruce Wayne withdrew $500 from the business. So when you're doing journal entries, you have the mindset of the business, not of the owner. So if you're a business and someone takes money out of you, is your cash going up or down? You should say it's going down. Someone's taking money out. So cash is decreasing. The account, when an owner withdraws money, is called owner's drawings. Every time an owner withdraws money, this owner's drawing account is increasing. So owner's drawings increase with the debit. So we're going to go debit, owner's drawings, 500, and we're going to credit cash. Cash is going down. It's leaving the business. So cash is decreasing. All right. So we're going to go ahead and post. Reference number 5 for journal entry 5. Owner's drawings increased 500. The balance is now 500. And cash again went down. Journal entry 5, credited for 500. The new balance is going to be 96,700. Okay? When you're doing this, you can make formulas if you want to help you out, but that's it ultimately. Okay? Now what we're going to do is we're going to use all these postings to update a trial balance. I made a real basic one. So on the trial balance, you go in order of the accounting equation. So you list your assets first. So we have cash, accounts receivable. I'm going to abbreviate it AR to keep this small. Accounts receivable, equipment. Okay? Then you go to liabilities. We have none. Then we go to equity, but you start with capital. So there's owner's capital, owner's drawings. Then there's revenue, sales revenue. Then there is just rent expense. All right, and to make sure I have them all, 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. Awesome. All you do for the trial balance is post. Is it a positive balance? Is it a debit balance or a credit balance? So looking at cash, it had a $100,000 debit balance. It decreased with all these credits, but it still has a positive $96,700. So it's debited $96,700. Put these all in dollars. All right, now I'm going to make a total line. And what I'm going to do on the total line is I'm going to sum up each category. The purpose of the trial balance is to make sure your debits equal your credits. If they don't, after doing this, something is wrong. Okay? Accounts receivable, nothing was changed. It has a debit balance of $10,000. It had no credit to offset it. We'll do capital. No, we'll go in order. Equipment. Equipment, we debited for $2,000. Nothing else happened. Debit for $2,000. Now we're at owner's capital. Back when we credited it for $100,000. So we're going to do the same thing. Owner's drawings has a debit balance. Okay, just because owner's capital was credited, we're going to debit owner's drawings. It doesn't mean we have to credit it too. Sales revenue, we credited it for $10,000 right here. So we're going to go over here, credit it for $10,000. Last, rent expense. Rent expense was debited for $800. Nothing else happened to it. So we're going to debit rent expense for $800. And voila. The total. Debits equal the credits. This is huge. If these debits don't equal the credits, something back here in your journal entries or in your postings is wrong. Many of you did a great job of posting accurately in the debit and credit columns what you did in your journal entries. The biggest issue was the journal entries themselves were off. So I implore you to practice doing journal entries with my method. Read the transaction, open your cheat sheet, figure out what accounts are affected by that transaction, and then figure out for each account, is it increasing or decreasing? And if you could just talk yourself through that, this solves the journal entry for you. It tells you, hey, if your asset is increasing, debit it. If it's decreasing, credit it. Okay? So try this out. Practice this. What I would do is, after watching this video, get rid of my answers on this Excel sheet, write it down on a piece of paper or in your own Excel sheet, and try to answer the same questions. Or go back to all the practice journal entries from Module 2 and practice those. And above all else, send me questions. Email me questions if you're lost. All right, keep a lookout. I'm going to be doing another video soon for adjusting entries. Okay?